Hello everyone, welcome to another QuantInsti webinar, and today we will be joined by two of our esteemed EPAT alumni, Raimondo Marino from Milan, Italy, and Kurt Selleslagh from Singapore. In today's session, they will be sharing their algo trading projects which they developed for the EPAT certification program. And the topic of our first presentation is Portfolio Asset Allocation, a Practical and Scalable Framework for Machine Learning Development, which will be delivered by Raimondo Marino. And the second presentation will be on Portfolio Optimization for Dividend Stocks, which will be shared by Kurt Selleslagh. Now, I would like to first invite both of our speakers. So, welcome Raimondo, welcome Kurt. You can hear me, right?
Yeah, loud and clear. Thank you.
Great, great. So I would like to first of all introduce both of our speakers. So about Raimondo. So Raimondo Marino is an independent artificial intelligence and big data engineer. So he's working with various small and medium companies in Italy. Through AI applications, he comes up with end-to-end solutions for different corporate functions within a company like marketing, HR, sales, production, etc. He's also a passionate quant trader who believes in efficacy of combining machine learning techniques with statistics and probability to design superior trading systems. Previously, he worked for over 20 years in the telecom industry, mainly in the business marketing offering and base management. Raimondo also holds a master's degree in electronics engineering from University of Naples and an MBA from SDA Bocconi of Milan, and also a postgraduate in machine learning and artificial intelligence from Columbia Business Executive Education from USA. So thank you for joining us, Raimondo. How are you doing today?
I'm fine, thanks. Thank you.
Great, great. So let's move on to the introduction of our second speaker of the day. So let's welcome Kurt, and a quick introduction about Kurt. So Kurt Selleslagh is a project manager at Hong Kong Exchange and Clearing Limited, and Kurt has more than 27 years of experience in the financial markets. He has held various positions like IT project manager, business project manager, quality assurance test lead, scrum master, business analyst, and consultant in his career with reputed exchanges and institutions like Hong Kong Exchanges and Clearing Limited, or Standard Chartered Bank, or NYSE Euronext, and the Capital Markets Company, to name a few. He has extensive knowledge of financial markets and products, especially in derivatives side, asset classes like equity, FX, commodities, and interest rates, systems, and regulatory environments. Kurt possesses deep knowledge of front office, electronic trading, post-trade processing, risk management, CCP clearing, OTC clearing, quantitative methods for trading and risk management, and also obviously algorithmic trading. About the education background, Kurt holds an MSc in financial engineering degree from the Nanyang Technological University in Singapore, and also holds numerous certification in fintech domain like blockchain, project management, cloud infrastructure, Python programming, algorithmic trading. And he's also passionate about driving and delivering new initiatives like infrastructure solutions, new products, platform implementations, and process improvements. So within the financial service industry. Welcome, Kurt. Thank you for joining us today.
Thank you for your kind introduction. It's an honor to be here.
Thank you for sparing your time, because I think this is late in Singapore, and you have joined us this late just for sharing your work with our audience. So I really appreciate that. And yeah, so let us begin with. Sorry, someone, you're saying something?
I'm still awake.
Thank you so much. Okay, so let us start. I think with a brief introduction about today's speakers, we'll now proceed with our first presentation. And what I'm going to do is I'm going to make Raimondo the presenter, and he can now share his screen. So Raimondo, can you please share your screen? The stage is yours.
Thank you. Can you see it?
Yes, yes, I can see.
Okay. Sorry, full time. Okay. Okay, good morning and good evening, everybody from wherever you are. I'm Raimondo, and today I'm going to show you how to build a scalable framework for portfolio weight allocation. The idea I pursued in the 𝗨𝘀𝗀𝗃 project, this part of the EPAT program, was to build a series of blocks that, when connected together, could allow the quantitative trader to use any technique or idea within a reproducible framework. But it could seem a little bit abstract, the idea, but in order to make things practical, I used some of the techniques, and I will show the results in the presentation. However, the framework is fully customizable, so basically you can use whatever, whichever idea comes to your mind. So this is the agenda. That's the agenda, and these are the points I'm going to touch during the presentation. And these I will skip because Mr. 𝗨𝗀𝗃𝗃 introduced me with his kind words. Okay, let's see. So why did I decide to embark on the 𝗨𝘀𝗀𝗃 project? I had this idea of building this framework. I was mulling over for a long time. And since within the EPAT there is the 𝗨𝘀𝗀𝗃 project, and this is basically a unique way to discuss your ideas with the best practitioners in trading and finance from all around the world. Something that I would say rarely happens to traders. Okay, let's see. Let's start from the main ingredients of this project. To build a scalable framework for portfolio allocation, you need 3 ingredients. First off, you need to design trading system with a portfolio mindset. I think that many of you have heard the famous saying of Miguel Cervantes, don't put all your eggs in one basket. So this is the first idea. It's really important if you want to design a portfolio trading system. The second idea is I called it trading system on steroids, because we should try as much as possible to convert our idea using machine learning models, because they are the most advanced tool today, even though the theory behind the machine learning models was designed in the second part of the last century. But thanks to the computational power of modern PCs, we can implement machine learning models. And this is the third point. We need to leverage the multi-CPU, multi-core, and the GPU capabilities of modern PCs in order to build this scalable trading system. I call this scalable because it can be, you can use as many assets as you like, of course, within the limit of the computational power of your PC. But I'll tell you more in a few. This is you can see the framework for low medium frequency trading. Because for high frequency, it's another thing. It's out of scope this webinar. But you can see the elementary blocks that you find here, and then we will touch every block of this framework in a minute. For sake of completeness, I also put the last part here. As you can see, when you go live, you need to put your system in paper trading. You have to use an infrastructure. Since I'm a developer, I'm an artificial intelligence engineer, I prefer to build myself using cloud services like the ones from AWS. But there are also many more simple services like Blueshift of Quantra. It is for people who don't have much experience in programming. But okay, just to show the blocks. But this part, the last part, I won't be covering this part because it's out of scope. Okay, but before before seeing every block, I would what you need in terms of skills and competencies to build this framework. As you can see here, you need at least, okay, the knowledge of portfolio techniques, of course, because in the end you want to apply some of them. You need to have a good knowledge of object-oriented programming in Python. Through classes, you can reuse your code. And this is really important. That's the reason why this is a framework. Framework means that by writing a single class, you can put this class and inherit from the base class in order to implement your ideas. And so you can implement whichever idea comes to your mind, provided that you write a class. Then there are a couple of techniques for concurrent processing. The first one is the multiprocessing techniques that allows to use multi-CPU, because generally when you suppose that you got a PC with 8 CPUs, if you code something, generally, unless you specifically use a Python library called multiprocessing, you will always use one CPU, and that's a pity, because we got currently very powerful PC. So why cannot we use all the CPUs within our PC? Then there is also the other technique called async IO, asynchronous programming. This is really important for requesting info to external sources of data, like databases and data providers. You can send 1,000 requests at the same time and get the results in a parallel way. And so this tool is also important. Then there is also the use of hyperparameter optimization tools. I just named a few here. Optuna Retune. These are basically I took this from when you optimize neural networks. You basically are dealing with tens of millions of parameters. Okay, in our case, it could be hundreds of thousands of parameters, but it's still a big number. So you cannot use the exhaustive search. You cannot try every parameter, every combination of parameter, because it would be impossible. So you need to resort to some tools that are really useful. The last two is some knowledge of SQL language, because you want to access a database. We will see just in a few. And the use of Docker technology that allows you to build locally an agnostic framework independent from the operating system. Okay, Docker is basically is a technology that, as the code name, Docker is a container when you put all your application. Here you can see that the books I studied from. These are very good books from my opinion. These are the books I learned all these techniques. And the last part is my configuration. As you can see, by spending between 5 and 10K USD, you can build a very powerful PCE that allows you to build a portfolio trading system. Okay, that it's based on multi-assets. Okay, now let's start with the first part, of the presentation. As you can see here, you need. So let's talk about the first part of the framework. You will spend basically between 60 and 70% of your overall time here. You need a database optimized for time series, like the one time scale, InfluxDB. There are many of them, but they should be optimized for time series because it's really important. Then there is the data preprocessing module, in which the minimum tasks you need to perform are missing data. You need to deal with outliers, data normalization, because assets are in different ranges, as you know, and perform, of course, the asset selection within the asset universe. So you download all the data from your data broker or data provider, and you have to choose which of the assets you will use in the following steps. Okay, so there are many techniques: liquidity, the spread between the bid and ask. There could be many criteria. So the data preprocessing step is really important. And as for the next step, it's called the feature engineering step. This is in terms of machine learning terminology, but it's more commonly known among traders as the alpha generation phase, where you can add any ideas which comes to your mind, where the only limitation is your imagination. Okay, so this is really important, because if you got an idea, whichever idea it comes to your mind, for instance, you are a fan of technical indicators, okay, you can put a technical indicator with different parameters. You build the columns. Basically, they are just columns of your data set. Okay, so you got the asset and you build many columns depending on the number of indicators you want to build. But there are also other kind of indicators: sentiment analysis, data and features. You can use trend seasonality. You can also use econometric models like 𝗨𝘀𝗻𝗂𝗋𝗃 and or whatever. So this is the alpha generation phase. Next phase is the feature selection, where it's rather the opposite. Let's say why this is the opposite. Because basically, there are many ways to perform feature selection. I will tell you just the basic tasks. That in feature selection is performed to select a few of the features added during the previous step, the alpha generation phase. Basically, this step chooses the ones that are most useful for the machine learning models. At least you should remove, I would say, in my opinion, constant and quasi-constant features. For instance, if there is a features that has a range variability within 5%, I believe that's my threshold, but you can also use 1 or 2%. Basically, it means that the features doesn't give you any added value to the machine learning model. So it's best to remove it rather than retain it, because it hurts the model instead of benefiting it. So the first one could be removing constant and quasi-constant features. The second, the other part is to remove non-stationary features, because, as you know, all machine learning models relies on the assumption that features are stationary. Because if machine learning models learns a pattern from the training set, that is the data in which the machine learning model is trained, and then the test set has a completely different probability distribution, you can imagine that the machine learning model won't perform. Its performance will be worse than during the simulation. Okay, so non-stationarity, it's really important to remove non-stationary features. And the other thing to do is to remove linearly correlated features, at least linearly correlated, using the Spearman rank. There are many coefficients you can use to remove linearly correlation among features. And at the bottom of the presentation, in the orange corner, you see the improvements I'm currently working on. The framework, in my opinion, will certainly benefit from the addition of new features, because during the capstone, due to time constraint, I only added some features, but I would like to add other features, like the ones you see in the presentation. And the other important thing is the use of fractional differentiation. I don't know how many of you have heard of this technique. It was devised by Marcos Lopez del Prado in the book I showed you before. This one, just to advances in financial machine learning. Basically, it allows the fractional differentiation to get the desired stationarity. So you don't need to remove the feature at cost of losing some memory without removing the feature itself. By applying this technique, you retain the features. You get the stationarity that is used for machine learning models, but you lose some of the information within the feature itself. But at least you can retain it. Otherwise, you have to remove it. So it's better to retain with less information than to remove it completely. Okay. So these are the improvements I'm working on. This is the first part. Okay. Sorry. I went to Okay, second part. Okay, second part is composed of, this is the second part of machine learning pipeline. It's composed of the rebalancing phase, known as here as portfolio selection and weight allocation, and the second phase is the backtesting evaluation. Okay, the rebalancing phase is basically composed of two steps: asset selection and weight allocation. For the first one, I decided to apply the cross-sectional momentum. That's basically, it's just an idea. You can use, as I told you before, you can use whichever technique. Just write a class and you can put it in this pipeline. I used cross-sectional momentum that's based on the relative strength between assets for choosing the assets. Then, during the weight allocation phase, I used traditional techniques like the critical line algorithm, the inverse volatility portfolio, the equal weighted portfolio. And as for machine learning models, I used hierarchical risk parity and hierarchical equal risk contribution. I will show the results of my simulation. But basically, as I told you, and I used the Python framework known as RiskFolio. I believe it's the most advanced. It's completely free. You need to understand how to use it, and it's very friendly, user-friendly, in my opinion. So RiskFolio is a good tool to apply many portfolio techniques. Okay, and finally, I evaluated in this, as you can see, backtesting evaluation. I evaluated the performance using 10 years of historical data and data difference metrics. But let's read the results. Okay, of course, think that this is not okay. Let's see that on the left you see the top performance. Okay, here you find the parameters I optimized during the asset allocation phase. The first one is the look back period. In this case, the best performance is 37 weeks. 0 is the skip period, is the number of weeks I skipped before during the rebalancing phase. So 0 means that I don't skip any. I take all the data up to the day of rebalancing phase. And you can see here that the best performance are basically all come from machine learning model, 𝗿𝗀𝗀𝗃2 and HRP, apart from one notable exception, inverse volatility portfolio, that is a traditional technique. Still, the best technique has a Sharpe ratio of 0.5. Of course, this is not the objective of my capsule. My objective was to build a portfolio. Then I'm going to try to improve this Sharpe ratio, because we need to reach at least of a Sharpe ratio between 1 and 2 in order to put it in paper trading and then live. As for the worst performance, you can see here that they come generally from traditional methods like equal weighted portfolio, inverse volatility. There are also some machine learning models, but most of them are traditional models. Okay, and as for the improvements, I will add the drunken monkey strategy. It's called the drunken monkey strategy, which is basically the random strategy of buying and selling assets, because I'd like to have a baseline. And then also use another advanced technique, also devised by Marcos Lopez del Prado. It's combinatorial purge cross validation, that basically simulates hundreds of thousands of historical paths instead of just one path. That you basically, what you do is you take your data, you divide training test split, or you can also apply the walk forward analysis. But even the walk forward analysis has its own limitation. In my opinion, the best technique to test your data is to use these techniques. There are also some implementation you can find on the internet, and just try to Google combinatorial purged cross validation. There are some Python implementation, so you don't need to rewrite from scratch like I did, but you can find many of them. Last part is this one. Okay, this is very, very important phase. It's called money management. You have to understand, this is one of the key points of my, I'm obsessed by this part, because you have to understand that the results I showed you before are just point estimates. Okay, these are just point estimates. Okay, And I know that if you're a trader, you know that when you go live, performance will almost always be worse than the backtesting. Okay, I would say always. In my case, it's always worse. So what you need to try to estimate the range variability of your parameters. Okay, and for me, there are many ways you can do it. For me, they were the terminal wealth and maximum drawdown. I will show the result in the next slide by using some techniques. So one of these is Montecarlo simulation. Montecarlo simulation can be easily implemented in Python. It relies on an assumption that's it's never true, that returns are normally distributed. As you know, the returns are more Cauchy distributed than normally distributed. So the improvement I'm gonna work is the bootstrapping. Bootstrapping method is another statistical technique that doesn't rely on the underlying data generation process. It means that basically returns can be distributed like with whatever probability distribution you can think. Bootstrapping can overcome this limitation of Monte Carlo. Still, Monte Carlo is very useful. So you need at least to get both of the results in order to make a comparison. Let's see the results. Okay, I'm almost done. Okay, because time is running out. Okay, this you can see here the terminal wealth percentile. Okay, and the maximum drawdown percentile. You can see that in 90% of the cases, terminal wealth goes from 85% to 1. It means that if you invest $1, you get from $0.85 to 1.31 in 90% of the cases. Okay, and for maximum drawdown, it's in 90% of the cases below 20%, 22%. Sorry. Just to be on the safe side, use terminal wealth at 5% here, and the maximum drawdown at 95%. So this is the worst result, of course, but I prefer to be on the safe side when choosing my system. Finally, there is always the possibility of a black swan who lives in the tails of the distribution. Here you can see a picture. The longer you trade your system, the more likely is to incur in a black swan. So we should be careful. We should also put a limit on how much time do we use our trading system in. Okay. I face a couple of challenges. I don't go into the details because I'd like to go to the last part. But Mr. Ishansha was a faculty member. He helped me overcome, and he gave me very practical advice. So I'm very grateful to him for his help during the project. And okay, let's go to the last. Okay. What I learned from EPAT, I think that first off, try to mitigate idiosyncratic risk by using different techniques. Okay, so trading system based on different underlying factors, different asset classes, different etc. Second, do not fall in love with your ideas because there is no holy grail in trading system, even with machine learning techniques. We should always be data-driven. I say data-driven guys. I know that it's really difficult because it happens to me, also to me. But we should try to not fall in love with our ideas. Use the KISS rule. What I mean is that between a simple system and a complex one that have comparable performances, choose the simplest one because it's most likely that the complex system you are overfitting it. It means that when you go live, performance will be worse. Okay. Finally, monitor and adjust your live trading system because time series are highly non-stationary and with the low signal to ratio, with the low to signal ratio. And that's it. I believe that the EPAT course is worth every penny. You won't find anything like that on the internet, and it's a key tool that any proper quant trader should have in their box. And Mr. Kijit, the floor, I finished. I'm done.
Thank you so much for this wonderful presentation. I think we have to rush through a lot of stuff because there is so much detailed things which we shared here. So yeah, but I think we can. I can still see a lot of questions here, and we can pick a questions or two because we are limited on time. So Raimondo, what I'm going to do is I'll just share these questions with you. So I have shortlisted a few questions. So
okay, let's see.
I think I have flagged a few questions. You can just select a few from them, and then we can try to answer one or two there. I think there are so many questions we are getting, but it may not be possible to pick all the questions. So as I always say, please make sure that you are sharing these questions at the end of the survey after the webinar, so that will help. And we just have to start with another presentation. So we'll pick one or two questions from here.
Okay. Do I have to answer here now?
Yes.
Or after
Yes, Raimondo.
Okay.
Yes, Raimondo. So Raimondo, are you able to see the questions that I have flagged for you?
Yes. I'm watching on. Can we get the PPT post? Yes, of course. I can send you the presentation. There is no problem for me.
Yeah. Those things will be shared. I think you can shortlist the ones which are flagged. So there are so many questions, but I have selected a few for you, which are the most relevant ones. So you can pick.
I don't. Sorry, but.
Okay, no issues. Let me pick questions for you. So okay, so this question is by Manogan Ramallah. Manogan asks for Raimondo, which process or step is in the pipeline would you say deserve the most attention?
Okay. Yes. Okay. Definitely, as I told you before, the data preprocessing step is really important because it gives you all the subsequent steps are influenced by the first step. So data preprocessing, and because the alpha generation, you can put whatever column you like, okay? Because in the end, it will be the machine learning model to choose which is the most useful feature. But in my opinion, the data preprocessing step is really important, and it's also the step in which you will spend most of the time.
Great. Raimondo, we cannot see you, so if you can turn on your camera.
Sorry.
So okay, this next question is by Faizan. Faizan asks, do you prefer to normalize data by subtracting moving average and dividing by moving standard deviation, or by using mean and standard calculated using the entire trained data set? I think it's a very long question.
So okay, sorry. Now you should see me. Okay, sorry. Okay.
Yes.
Okay, in my opinion, okay, as for the data normalization, I believe that in most cases, standard normalization, so subtracting mean and dividing by the standard deviation should work. Even though you can always try different techniques and build your pipeline, because with classes you can try the standard mean standard deviation, or you can try all the min max, and you can also pipeline, and you can try to simulate every different path, in my opinion. But most of the time, the standard scaler works well, in my opinion.
Perfect. One last question. This one is by Lucas. Lucas asks, can we remove linear correlation using a PCA?
Yes, of course you can remove it. You can use a PCA. The only problem is that you lose the meaning of the feature. That basically this step could be okay. You can do it, but in my idea, when some machine learning models gives good results, everybody thinks that the machine learning models are black boxes. It's not complete. It's not true. And I believe that they could be in somehow explained with some models like Shapley additive value. But PCA is a good way to remove linear, but yes, I would prefer that the job of choosing or coupling features should be done by the subsequent phase of weight allocation, and rather than during this phase. So I would prefer to use removing linear correlation by using the standard coefficient, the Pearson coefficient. But then you can try it. Of course, there's no you can do it. The problem is that you lose, since you lose the meaning of the feature after you applying the PCA, it's difficult to understand whether the system works or not. I always try to find an explanation if the model works, has good performance. You need to try always find a reason why this model works, and that's the only. I'm a little in doubt by using PCA, but of course there are no. This is not true. In absolute, it's not true.
Great. Okay, so I think that's about it, and I'll just have one last question, and that is a generic question that I generally ask to all the EPAT alumni who are conducting such sessions. So, and that is, do you have any word of advice to aspiring quantitative and algorithmic traders?
So, are you talking
I will
to
repeat
me?
the question. Yeah, I will repeat the question, Raimondo. So it's not listed anywhere. It's just a general question that I have. So any word of advice for aspiring quantitative and algorithmic traders?
So why are you asking me why? Because there is some noise here. Sorry, you are asking me why there is how to start a career as an algorithmic trader.
Yes.
Okay.
Like, do you have any advice for people who just want to get started?
Of course.
Yeah.
Of course. I believe that EPAT is a great start, definitely. As I told you before, I'm not doing any ads because I'm an passion. I just graduated from EPAT. I'm very an enthusiast, even though previously I had the experience in machine learning, but it gave me the other part of the. So basically, the people who attend the EPAT are traders, so I have experience in finance and don't have experience in other parts, or people like me who have experience in technology and don't have experience in finance. I believe the EPAT it's a great way to become a quant trader. If you want to, if you got them, I highly suggest you join this course, because there's anything like that on the internet, in my opinion. That's my opinion. So.
Thank you so much, Raimondo, for these kind words. Okay, so I think now it's the time. So thank you so much for this wonderful presentation and answering these questions. Now, before we start with the second presentation, I would like to share that the EPAT early bird admission for the next January batch were closed recently, but we are extending the early bird admission offer to our today's webinar attendees. So you can simply book a course counseling call to understand how EPAT can help you become a better trader. And so it's not just a call to enroll in the program, but it's that you get on that call, and whatever your learning objectives are, you can discuss them, and you can try to understand how EPAT can help you achieve your goals, career specific goals, or if you want to start your algo trading desk, or you want to take your existing trading strategies to another level, apply machine learning and advanced technologies and tools. So it's a very comprehensive program, and you can align your objectives, and you can get benefit from this course, because this is not just taught by any college professors, but it is a course which is being taught by industry experts and practitioners themselves. So you'll get to learn from the very top industry experts in the space. All right, so I have shared this link in the chat, so you can basically book a calendar call, and some of our team members will help you understand how it can help you, and if you find it that it can really add any value to your life, then definitely you can consider this course. All right, now Wonderful. So let's move to the second presentation. And the second presentation for that, we have Kurt here with us. Hey, Kurt, you can turn on your camera. I can see you. Yes, great. So, all right. So perfect. So we can start off with our second presentation. As I said, a very quick introduction about Kurt. I have already introduced him, but Kurt Selleslagh is a project manager at Hong Kong Exchange and Clearing Limited, and he has more than 27 years of experience in financial markets across various roles, right? And he has worked with very prominent exchanges and institutions, as named a few: Standard Chartered Bank, NYSE Euronext, Capital Markets Company. All right, so without any further ado, I'm going to make Kurt the presenter, and he can share his screen now. So, Kurt, the stage is yours.
Thank you. Can you see my screen?
Yes, we can see your screen.
Right.
It's on the third slide. Yes, we can see.
Let me put it in presentation mode. All right.
Perfect. Looks good. Yeah.
Okay.
Yes.
Thank you.
Yes, yes.
Yeah, the project that I chose builds upon the lecture PRM02 Quantitative Portfolio Management by Jay Palmer, which I personally found one of the better lectures in the whole program. But it was focused on optimizing portfolio value, purely focused on the price or the value of the portfolio, maximizing. I took one step further. I extended it to optimizing dividend yield that you can obtain through portfolio management. So I extended it to dividend paying stocks. My motivation was to, at some point in time, to get a regular dividend income stream, passive income stream from investment. At the same time, also wishing that the dividends grow in time, that the dividend payouts would be stable, and that there would be no loss over time in the portfolio value. So that's what I wanted to see, whether that's possible to achieve with the techniques that we learned in the EPAT course. It was actually to satisfy my curiosity if that was actually possible to do so, because you have two variables, the price and the dividend payout in a portfolio. I also wanted to see if we can, through optimal portfolio management, beat the benchmark, like a benchmark index or an ETF in both dividend yield and price return. So the techniques, my project is not very complex. I definitely don't possess any of the machine learning capabilities that Raimondo has. I'm not an expert in programming. I just know basic of everything. So my portfolio, or my objective, was to have it low key, something that I personally could apply in my personal life, or that other people could apply as well. Okay, what approach did I took? And I will show you some results later. So basically, well, first starts with, okay, you need to select stocks that return dividends, and for which an index or an ETF exists that you can use as a benchmark. The first problem was obtaining dividend data. Price data are generally widely available. There are lots of free sources and paid sources to get price data, less so with dividends. I chose, because I'm based in Singapore, my investments are in Singapore dollar, and don't want to incur any FX risk. So I chose the STI, Straits Time Index, as a benchmark. And there are basically not a lot of dividend or free dividend sources available, or dividend data sources available. I found two of them, and then I had to code some web scraping function to download the dividend data. I divided the data set into two parts, 2 times 10 years. That covers economic recessions and expansions in each of those 10 years. So the first 10 years were training data, the last 10 years test data. Also challenging was that I had to do a lot of data cleansing. The data was definitely not clean. The website lists not only dividend payouts, but also other corporate actions, such as rights. You need to scrub that out. Especially in the early years, like the 2000s, early 2001, 2002, the dividends were expressed in percentage. So you need to convert that to a dollar amount. Some of the dividend stocks, they don't pay out in Singapore dollars, they pay out in US dollars. You need to normalize that, bring it back to Singapore dollars. So a lot of time and effort was spent in data cleansing. Price data, that was definitely easier to obtain from Yahoo Finance. Again, for some stocks, you need to do a conversion to Singapore dollars. So once we have all the data, we need to calculate some metrics, dividend payout metrics and price performance metrics. And then, well, it's always interesting to see some plots, dividend versus price. I had the choice of metrics to look into, and eventually I chose one that I wanted to optimize. So for dividends, we are calculated and we can choose the annual dividend yield, that's dividend over price, or dividend against the base year. I also was interested in knowing what the dividend growth is, average dividend growth over those 10 years. And another factor was the variability of dividend growth. I wanted a stable dividend income, not something that changes drastically every year. And I combined those two, average dividend growth and variability of dividend growth, in a what I call a dividend growth Sharpe ratio, just the average over the standard deviation. For prices, I computed the standard price metrics: net return, mean return, variability of return, calculated the Sharpe ratio, looked at the correlation of price returns, calculated the maximum drawdown. And then, because I was interested in both dividend aspect and the price aspect, I combined the Sharpe ratio of those two, multiply the dividend growth Sharpe with the price return Sharpe. And ultimately, I multiplied that ratio with the average dividend yield, because that meets my investment objective of maximizing the dividend yield, maximizing the dividend growth Sharpe, i.e. I wanted a steady growth, a positive growth, and not a growth with high variability, and also wanted a positive price return, and again, where the standard deviation is actually quite low. So this composite, I called it a composite ratio, is the metric that I calculated, and that I, for all the different stocks in the portfolio. Then once I've calculated the different metrics for, I think it was 30 stocks in the portfolio or in the index, I needed to do the same calculation for the benchmark ETF, and then comes the more interesting part, portfolio selection. So I chose 5 stocks with the highest combined metric, this composite ratio. I created 2 portfolios, one equally weighted portfolio, which is here called portfolio 5 underscore equal weight, EQW. And then I used a portfolio weight optimization method, as seen in the lecture, to calculate the optimal portfolio weights for those 5 stocks. And that portfolio was called underscore OPTW. And then for these 2 portfolios with 5 stocks, I calculated the same performance metrics and compared that against the benchmark. In the lecture, it was mentioned that by Jay, that some portfolio managers, they do an optimization once and then keep that portfolio for the long run. I wanted to see, okay, if I just optimize once, after 10 years, and then I keep that portfolio for the next 10 years, I should actually be outperforming the benchmark, the ETF, and actually both in terms of dividend and in terms of valuation. Now, what were the results? So here you see a number of graphs with the different metrics. Basically, here in the top left quadrant, the bubbles that are colored green, those are the 5 stocks. I mean, 1, 2, 3, 4, and then 5. The 5 stocks with the highest combined metric. And then I calculated the portfolio of that, ones with equal weight and one with optimal weight. So all of them actually have a higher mean return and a higher dividend yield than the benchmark. The benchmark is called ES3. That's the STI ETF. They also have a, and that's in the top right quadrant, a better dividend growth sharp and a price return sharp than the benchmark. And when you put those metrics together in the bottom left quadrant, my optimal weighted portfolio here in light green has a better average dividend yield and dividend growth sharp multiplied with return sharp than our benchmark ES3, which is here. And the portfolio also has a lower maximum drawdown than the benchmark ES3. So that was for the first 10 years. It all looks very promising. And I thought, okay, the next 10 years will also be very promising then. And to my surprise, it was not the case. The next 10 years, from 2012 to 2021, completely turned the tables, because there were other stocks in the next 10 years that basically became more attractive, like banking stocks and technology stocks. So the next 10 years, the stocks like V03, technology, or technology stock, D05 banking stock, U11 banking stock, they all became more popular in the next 10 years. So the optimized portfolio started actually, when you keep that static, performing worse than the benchmark ES3. And you see that also here in the bottom left quadrant. It has a lower average dividend yield and lower dividend growth and lower price return sharp than actually the benchmark ES3. And it has also a lower drawdown. So I thought, okay, that doesn't look good. What can we do about this? And I tried to see whether we can improve the performance by rebalancing. So every period, you look a number of years back, and you try to select the best 5 stocks in that period and hold them for 1 year, and then calculate the performance, both dividend and price return performance, and then move that window forward. In the next year, you look again, a window back, and choose the best 5 stocks based on your metric. Hold them for 1 year, calculate again the dividend performance and price performance. So it's like a recurring method where you always look back and then 1 year forward. I choose different look back windows, looking back 10 years and looking back 5 years. Made some other variations, like if I only look at Singapore dollar paying stocks to exclude any FX risk. And the results start to look more promising. So in the top left quadrant, you see here the rebalanced portfolios every 5 years and every 10 years. They now start outperforming the benchmark index or benchmark ETF, ES3, are static portfolios here at the bottom. They actually have score much worse. So the rebalanced portfolios actually score better on all the metrics, have a higher dividend yield, better dividend growth sharp and return sharp than our benchmark index. And most of them also have a lower drawdown than the benchmark. So that was actually quite promising. And how does it actually do in absolute performance? So the benchmark ETF had an average dividend yield of about 3.5% through portfolio optimization and regular rebalancing every 5 years. Sorry, every year with 5-year look back, I can achieve a dividend yield of more than 5%. And my price return or the portfolio value also outgrew the benchmark ETF. And then I was interested to see whether we can replicate the same for another type of dividend stock, the real estate investment trusts. The advantage there is there are a couple of advantages and disadvantages with REITs. They have a more regular dividend payout, so you can more frequently backtest. One of the drawdowns with or disadvantages with dividend stocks is so most of them only give a dividend payout once a year, so you can only look at the results on an annual basis. With REITs, you can look at it on a quarterly or semi-annual basis, but then you don't have such a long history with REITs than with stocks. The first REIT was only listed in 2002. There's a benchmark CLR that I compared with, and I basically applied the same principle. That is, look at the rebalance your portfolio on a regular basis, in this case every 6 months, and with different look back periods, and see whether you can actually outperform the index or the benchmark here, CLR. And that was actually the case. The index or the benchmark ETF gives a dividend yield of about 4%. With regular rebalancing, you can achieve 5% payout, and here the value of the portfolio also outperformed the index. That was up to July this year, because the last with REITs, some of them pay out on a quarterly basis, others on a 6 monthly basis. So you need to normalize that. Take the lowest common denominator at 6 months. So the last time I looked at the last data points I have is from June this year. I don't know how the portfolio performed for the next 6 months. It definitely wouldn't do well in terms of price performance, but I will take again a data point at the end of the year when December is complete, and then see how it performed. So here the results for REITs, whereby the rebalanced portfolios, circled in green, have outperformed the index or the benchmark ETF CLR, both in terms of average dividend yield, dividend growth sharp, and return sharp, and also drawdown. Drawdown was actually quite low. Challenges, definitely obtaining data and data cleansing. There was a large part of the coding went into data cleansing. Coding was not so difficult. Again, I'm not an expert developer. I know a bit of Python, but I had to create new libraries for web scraping, the data cleansing. A lot of coding went into that. The function for rebalancing was actually, in my opinion, a bit complex. I didn't use any object-oriented programming. I'm not good at that, but it's something that I think would help in making the code more reusable. But I got a lot of help from Google actually. If you don't know how something works, just Google for it, and you will definitely get an answer that you can then try out. So my learnings were that the method of optimizing once and then forget about it and hope that you will outperform doesn't work. You need to frequently rebalance your portfolio. And in the case of dividend stocks or REITs, because of the scarcity and infrequency of dividend data, you can only rebalance once a year, or for REITs twice a year. The optimal look-back period would be about 5 times that dividend frequency window. Next steps, well, there's definitely a lot of more work that I can do on this project. Looking into different optimization criteria, adding more stocks in the portfolio for greater diversification, alter the portfolio weights. So, for example, the top 5 is now equally weighted, but I could use a different weighting for depending on the performance metric. Definitely continue backtesting, especially for REITs, because they had a short backtesting period. Again, the first REIT was only listed in 2002, and then if you need to look at a portfolio of more than 10 REITs, then your history is actually quite limited. I'm sure there's some survivorship bias in the portfolio, but that's difficult, I guess, to circumvent or overcome, because once a stock or REIT is delisted, the whole history disappears, and it's difficult to obtain that history, either price or dividend. So I think you need to start keeping your own database going forward, and I think extending the universe of REITs and stocks is definitely something to look into. Maybe other markets apart from the Singapore market offer easier access to dividend information. I will definitely continue to work on this project when I have time. Time is scarce at this moment. Yeah, and then I open the forum for some questions.
Thank you so much for that wonderful presentation, Kurt. So we already have received a few questions. It's just that we are running out of time. So again, I'll repeat, we'll pick a few questions here. So I'll speak the questions out loud for your convenience, Kurt. So this question again by Manogan. Manogan asks, for Kurt, did you decide to limit the universe to one particular region, or were your stocks from both emerging and developed markets?
Just a Singapore market. I don't know whether that's developed or a developing market. I'll leave it in the middle, but it was just the Singapore market because I wanted to exclude any FX risk.
Okay. So yeah. I hope that answers your question, Manogan. This next question is by Vicky. So Vicky asks, what was the weight optimizing procedure used? Can you share the name of that method?
You will see that in the lecture PRM02.
Okay. Okay. All right.
Yeah, if she has attended EPAT, I think PRM02 would also appear in the batch 55 or 56. But it's explained there. If you don't attend, or if you're not attending EPAT, I can send that to you afterwards by email.
Mm-hmm. Okay. There is this question. I think this question is to both the speakers. So Raimondo, if you're there, you can also pick this. So this question is for either the presenters. And does differencing of financial time series and removing outliers decreases the predictive power of using machine learning algorithms? Do you guys think? It's a long question. I am just breaking it down. as financial time series don't typically naturally occur without any outliers and or stationarity.
Who goes first? You, Kurt? Would you like to?
I can answer that because I didn't use machine learning in my project.
Okay. Alors, first is about outliers. Okay, I would say that it depends on the nature of it. Outliers will definitely hurt machine learning linear models. It means that if you want to use linear regression or even neural networks, they are hurt by outliers. While there are other models like tree models that are less sensitive to outliers. So I highly suggest to treat outliers. There are many techniques. You can use interquartile ranges. You can use lasso and ridge regression. These are techniques in machine learning models, but they can be applied using just using some parameter in the API. So basically, in scikit-learn you can use just a parameter. If you want to use a lasso regularization or ridge regression, you can use it's just a parameter, so you don't need to understand all the math that's behind. But as for the outliers, I believe that since in trading, as for my experience, the best results are obtained with the linear models. So I think that outliers should be treated, and that's my point. Unless, as I told you before, there are some tree models that are less sensitive, so you can use outliers with tree models like gradient boosting or bagging. You can use whatever tree models whichever. Okay. And I don't remember the other issue was regarding which is the first was outliers, and the second one was.
It was just it's same question which was continued, which says as financial time series don't typically naturally occur without any outliers. So I think it's the same question. So you have
Okay, sorry. So as I told you before, in my opinion, outliers should be treated with machine learning models, especially with the linear ones. That's the reason, because there are many. If you Google on the internet, you will find that if you use a linear regression with some outliers, the slope of the model is heavily influenced by outliers, and so in my opinion they should be treated. There are many techniques. It's not necessary to remove them. You don't have to remove them. You have to sensorize. There are many techniques, and there's not much time to explain all of them, but if you want, we can give you some ideas on how to treat outliers. But in my opinion, they should be treated.
Well, thank you so much for that detailed explanation. And Cole, I guess you got your answer. So yeah, I think that we are over time by 8 minutes, and thank you so much to our speakers for taking out your valuable time and joining us here, sharing all the experience with our audience. And to our audience, in case any of your questions went unanswered due to the limited time that we had, we would love to get in touch with you and address all your questions. Please make sure that you are sharing those questions. At the end of this webinar, you will get a survey. Share your questions there, and we'll try to answer all your questions and connect individually. And yeah, I think a link for the EPAT program. Yes.
Can I answer one of your earlier questions? A general question. You said, what does it take to be a algo trader or something?
Definitely. Please, Kurt. Yes, definitely.
I think it's a multidisciplinary approach. You need to understand the markets, definitely understand the microstructure of the market. You need to have decent coding skills in whatever language that you prefer. I think, and if you embark on machine learning, you must definitely understand these concepts. So for me, a combination of understanding the markets and being able to formulate your ideas and use a computer programming language to translate those ideas into executable code is definitely helpful, right? So and the EPAT course actually covers all of these aspects, the understanding of the how the markets function, understanding the Python code, applying the Python code to the to some of the ideas that you can apply, and also risk management. You need to be able to manage your risk. Don't go all in and throw all your eggs in one basket. So I think diversification and knowing how to diversify using programming language is very important.
Wow,
I think
thank you so much.
I also definitely concur with Raimondo. EPAT courses or the program is definitely one of the best that is out there. It's such a comprehensive course. It is very intensive for those 6 months, but you will learn so much, and there will be something for someone to that will be interesting and that he or she wants to take forward and apply in their own personal life. Whether you want to go how to say do high frequency trading like some do, or very low frequency trading like I do, there will be something for everyone in it, and it's highly recommended.
Thank you so much for such kind words, Kurt. And I think the synopsis that you shared, I mean, the entire journey that you had in the last 27 years in the financial markets, and then getting such feedback on the courses that we have, I think it's amazing, and it really motivates us to do more on this space. Thank you so much again, Kurt and Raimondo, for taking your time. And we'll definitely soon plan much more detailed sessions based on the audience demand, because I got tons and tons of questions, but we had very limited time, and we would definitely want to explore more of such topics in our upcoming sessions. Thank you so much.
There's so many ideas and too little time to apply them.
Definitely. Yes. Thank you so much, Kurt and Raimondo. You guys have a great day ahead, and thank you so much.
Thanks for inviting us. It was a pleasure. Have a great evening. Bye-bye.
Bye-bye.
Thank you. Bye-bye.
Thank you.